Hey everybody, it's Blake Ragland here at Bradshaw and Will. I'm sitting down with Brandon Morgan again, our certified financial planner here. And then if you watched our last video, we talked about the two phases of retirement. So we talked about the accumulation phase and the distribution phase. And in that video, Brandon mentioned the potential retirement danger zone, and that's what we're going to talk about this week. So Brandon, first question is, when is this potential danger zone in your retirement?
I would say the potential danger zone is approximately 5 years before and after retirement. And I say approximate because I don't think it's just a hard and fast 5 years. I think the closer you are to retirement, just on each side, there's the greater danger for risk, and then it tends to lessen a little bit. And at the end of that 5 year period on either side, it's not like it's 100% dissipated, but I think the bulk of the potential danger within that 5 year period of time.
Okay, well, let's break it down a little bit more. So we talked about the accumulation phase.
Right.
Well, let's start there. So
Okay.
where are those potential dangers in this accumulation phase?
Okay, so we're talking about the 5 years before retirement. And first off, you have decisions that will impact your retirement that are important to make good decisions, right? So when will you retire? At what age? Will both spouses retire at the same time? Where will you live? Will you live in the same town? Will you live in the same house? Or will you downsize and get another house? There's a lot of decisions that you need to make. Social Security. Just because you retire doesn't mean you have to start drawing it. So you need to look at that. Probably in some future videos we may dig into that more in depth. So there's a lot of decisions you need to look at before retirement to set you up for a good retirement. Also, you need to look at your investments. We said in the accumulation phase that being aggressive is the way to go, and I'm in agreement with that. But as you get close, you may want to just slightly reduce the strategy. And if you're looking like at that 5 year out period, maybe every year before retirement, you might reduce 5 or 10% of the amount of stocks. And the reason for this is simply you just don't want to get, say, the year before retirement and have $1 million in your 401k. Then the market drops 50% like it did in 2008. Now all of a sudden you retire and you got $500,000.
Oh, yeah, that wouldn't be good.
So you don't want to do that. So you want to be very aggressive in accumulation and then just slightly reduce risk as you approach your desired retirement date. Does that make sense?
Yeah, that makes perfect sense. And well, let's go to the other side of retirement here. Let's go to that distribution phase. And we talked about last video how complex it is. So where are those dangers here? I'm sure there's plenty of them.
Right. And I would agree. After retirement is a more complex stage than before. And in this 5 year period, it's these first few years after retirement that it's very important to get started on the right foot to have a good retirement. First off, you want to make good decisions. Healthcare, when you're working, a lot of times people might have had group health insurance. Now you retire, you have to make a decision there. For a lot of people, it might be Medicare in combination with some Medicare supplement, but then you have to choose which one of the med subs. You know, you have different ones. You have to evaluate which one's best for you. The second path you can take in retirement as far as healthcare is concerned is what we call Part C, Medicare Advantage. Now, for some people, this might be an option. It generally is a lesser premium than Medicare combined with a Medicare supplement, but you have to really look into it because typically your deductibles and your coinsurance will be higher, and oftentimes you may have a network of doctors and hospitals you have to go through. So that's a possibility, but you want to do your research. Also, while we're talking about health care, it's a subject nobody really likes to think about, but it is prudent to at least look at long-term care insurance. And that's not a product that I would recommend to everyone. It depends on your net worth and your own specific situation. But I think we all realize just how expensive long-term care can be. And right now it seems like the inflation on long-term care is going up faster than overall inflation in general, which is pretty high anyway, right? So that's a big threat to your retirement nest egg. You just need to address it and figure out what the best strategy for you is. Taxes might be another area to look at. Your Social Security can be taxable up to 85%. And there are ways to position your assets to reduce this tax. So that's important. Another thing a lot of people I don't think realize is just the order of withdrawal in retirement can have a huge impact on your taxes. For instance, you have various investment accounts and they have different tax statuses. You might have a non-qualified account, you might have a regular IRA, you might have a Roth IRA. And so in retirement, in what order you draw these out can make a huge difference in how long your money lasts. So that's very important. And I think most economists are assuming that eventually tax rates are going to go up, so tax planning is going to be very important. Right now, another risk that we're seeing in the economy is inflation, right? So it's important also to make sure that your assets are keeping up with inflation over a long period of time, especially if you live to be a very old age. So that's also important. So it's all these decisions, but also your investment management. I hear a lot of people say as you get older to reduce risk. But really the most important time that you need to make sure you're secure is this first 5 years of retirement. If in those first 5 years you have an investment account that has negative returns and at the same time you're taking money out of those accounts, that's a double negative. And that really has a detrimental effect on your overall portfolio, can really reduce it. Some people can completely run out of money, but in any effect, it has a potential risk for you. So that's very important to look at that.
Yeah, and I'm really glad you brought that up, because that's actually what our next video is going to be about. It's called sequence of return risk. You know that. So it's drawing out of these investments that are down, and it's causing this double dip. It's really going to deplete your retirement. So I really hope everybody enjoys these videos that we're doing, because they're really important to take into consideration. So please tune into our next video about sequence of return risk so you can get a lot of knowledge there and prepare for that distribution phase of retirement. So thanks for tuning in this week, and make sure you come in and see us for our next video. Thanks.
See ya.